Welcome to TheoTRADE. This is Don Kaufman. It's October 11th, 2024. Just about an hour to go to the cash close here on this Friday afternoon. The S&P's taken off to the upside, up some 31 handles. But I got to tell you, the volume out there, it is light, people. Light and fluffy volume throughout the course of this entire week. Right now, again, with an hour to go to the cash close, we're only doing 730,000 contracts. Now, for those of you that do not speak market geek, that's really, really light. This is like holiday kind of light. In fact, on Monday, it's a banking holiday, Indigenous Peoples Day. The markets are open. The bonds are closed, but the markets are open, but the bonds are closed. So equities are open. Equities will trade on Monday. Maybe that's actually one of the reasons, of course, that volume is light. But overall, it's just been stuck in the middle with you. Look, it's fear has this market just kind of locked up in a range. And you're like, well, where's the fear, man? We just keep, trenching to the upside. And the answer to that is, yeah, but so does volatility. I mean, volatility over the last couple of weeks, this is significant. And that's exactly what we're going to explain here in quite some detail, of course, on this weekend update. Let's get right to it. The first thing I'd like to talk about is what I've been calling, tight range, high volatility, or better yet, as I said a moment ago, stuck in the middle with you. Look, here's the range that has kind of defined us all. And when I start talking about the range, we jumped into this range all the way back, okay, in kind of mid, if you will, September. So somewhere around like September 19th, we jumped into a range. Now let me kind of box this out for a second. I'm going to start talking about the range. Yeah, that is what I am referencing, okay? No question about it, stuck in an incredibly tight range. And as I said, this is a range that's going to define us all. And I want to make that very clear because ranges like this, I was talking about it on Wednesday's video, ranges like this is dangerous. We just keep, we keep building in terms of risk. And you're like, if you don't see it, it's just, maybe you're not familiar with the options side of the business, but the longer you actually trade, okay, in a particular area, the larger, if you will, the ball of risk grows. So you sit here and the open interest just builds and builds and builds, okay, to the point where you got one big freaking snowball, and that snowball, gets unleashed upon you. Now, there's just no question that this afternoon we have, in fact, popped to the upside of this range. And I want to highlight this in, 10 different ways just to show you. So we've popped, but the day is young, and there's just, interestingly enough, there's no size behind it. When we initially popped out of the range, okay, this matters, by the way, the volume actually picked up, and then everything kind of just died out. It's not where we're trading right now that interests me. It's how we're going to close today. And that's going to be of critical importance because you might fade right back inside of that range. But when I say it's kind of like the range, that defines us all, ranges like this end with kind of wild, like binary moves. And as I was saying on Wednesday night's video, like nobody likes that term, like it's a binary move. That literally means you're like a coin flip of a way of exploding to the upside and or, ripping to the downside. Again, people were asking, what's your opinion? Well, I've actually maintained some short positions in the marketplace. So I'm inclined to believe that we rip to the upside only to come like fading back down. And that's actually, well, why are you inclined to believe that? Always got to have a reason for it. It has nothing to do with like economic factors, has nothing to do with interest rates. It has everything to do with the fact, though, that volatility remains, okay? I mean, volatility is just relevant in this case. It's relevant in every way, shape, or form. And again, it's okay. Like if you don't agree with that, everybody likes to look at the other side of the marketplace. But what's relevant to me is like, VIX earlier this week actually popped the upside of its expected move. It kind of came in a little bit, but I mean, I love to break down volatility and VIX. I love to break this down on a week-to-week basis, like here in expected moves, because you look over like what's happened like the last, 2 to 3 weeks. This right here, and I'm highlighting is 3 weeks ago, we started to pick up a little bit in volatility. last week we really picked up in volatility, and this week we took off. Okay. I mean, volatility has been higher throughout the course of this week, but the marketplace is also higher throughout the course of this week. So that, people, is a bit of a catch-22. You are seeing a marketplace that is going higher with volatility going higher. And for those of you that have been around this business for a period of time, why do you think I'm calling it fear has the markets locked in a range? I have to tell you, I've seen some crazy things before, but markets going up with volatility going up, yeah, that makes me nervous. There's just no question. It makes me nervous. And there's other gauges of, like, how I kind of measure, like, a little bit of fear trade. One thing that definitely bothers me, and I was talking about this again in Wednesday night's video, is that Walmart's up, 50% year-to-date basis. But even more so, you look at stuff like XLU, like utilities. No one has ever wanted to buy utilities, like, in the history of utilities. Like, this is the utilities over the last 5 years. They've made a bigger strategic move this year than in the previous, umpteen years, even in some big sell side activity. That was back in COVID, right? This move to the upside, and here's the irony, the move to the upside right now is actually bigger, okay, than the move to the downside that we saw around COVID. Now, that should be intimidating, and it does. It intimidates me. Like, look at this, 15 years of utilities, and you haven't seen a move like this. Okay. And that's one of the reasons that I keep bringing it up and harping on it, because we're in a tight range inside of the S&Ps, but you got this high volatility. And speaking of volatility, I would be remiss not to mention, of course, things like SKU. SKU is still sky high. For those of you, again, that don't speak SKU geek, SKU is trading like, 153, 154, 155 throughout the course of this week, which is still in record territory. All right. SKU doesn't do it for you. Let's look at VVIX volatility, the volatility index is still above the 110 region, which means everybody that's anybody is still hedging risk out there. So there's not much to say. Like, I know that we could sit here and prognosticate about different levels in the S&Ps, but the bottom line is right now we have popped to the upside. Okay, it's going to matter where we trade, not just today, but today is some light volume into the close. Monday is going to be a slop fest. Why is Monday going to be a slop fest? Because, as I said, equity markets are open, bond markets are closed. I don't expect much out of Monday. Coming in, though, to like mid next week, things are going to get serious. Again, this range defines everything that we do right now. The next thing I want to touch on, because we're in a tight range, well, let's further that. Let's cruise over to the SPX. Inside of the SPX, we have right now, and I'm just going to kind of zoom into these last 3 weeks. This is what I call 3 weeks, no touching. We've had not a touch of the upper or lower expected move. We have not touched the upper or lower expected move in 3 consecutive weeks. Now you will go, well, that's an anomaly. Yeah, there are times that this happens, like 3 consecutive weeks is unusual. Okay, no question about it. Like, from a probability point of view, well, that's not a high probability of occurring. I actually found one instance of July of 2020. There were 4 weeks in a row in July of 2020 where we did not hit expected move, but at the same time, volatility was high back there in July of 2020, and then things got crazy. That was coming out of the COVID crash. Things got crazy thereafter. So there is, again, like this, if you will, like a pent-up aggression, and definitely at the high end of the range right now. Okay, but we are just not. We ain't home yet. So even though we're popping to the upper edge of the range, it's not where we are right now. It's where we're actually going to close today. So 3 weeks without touching the expected move. Now, the reason I'm bringing that up, and you'll see me talk about this later again, is that volatility for next week, it has come down a little bit. Okay, it's right around like 87. But although Monday's open, nobody expects anything. So for the most part, the vol has come off, but nominally so. And that's also very, very unusual. Okay, so you have, a lot of unusual occurrences going on in this marketplace, but without touching the expected move. And again, quite frankly, the market hasn't done that much this week, right? So here we are starting the week at 57.50. Here we are trading at what? Okay, you can see the absolute high, but we're trading right 58.15 right now. So what are we, 65 handles higher? But you had a $106 expected move. So, you got a little over like half the movement basically on the week in here. it's not exactly getting it done at this particular point in time. Now, stop right there because I'm going to come back to that. So 3 weeks without touching the expected move. All right, what am I prefacing with that one? Okay, I mean, look, what I've said the last 2 weeks, get ready to rumble. And I think you have to be. You just got to look for these explosive moves that are going to occur. Because as I said, when you pop out of a range like this, we've just been gathering and gathering and gathering steam. And all of a sudden, what's going to happen is there's so much like open interest, so much volume that accumulates, even in a low volume situation. As soon as you come out of the range, every market making firm has to hedge in the direction, okay, of the move, meaning that if we pop to the upside, it's going to be like, just extreme move to the upside. And right now, okay, yeah, it counts because we are to the upside of that move. And you could even see a squeeze, if you will, into, okay, today's close. So, but let's not go there just yet. Okay. So next thing I want to cover over here. Oh, allocate accordingly. This is something it's always a difficult conversation because, like, on a weekend update and so forth, right? Yeah, markets are exciting. Markets are not that exciting the last couple of weeks. Okay, there's lots of trades that we've been able to put on, but they're not that exciting in terms of overall allocation. Because right now, one of the most important things that I can instill upon you, okay, don't force allocations right now. Let's say that again, don't force allocations. Whether you're doing in-out spreads, okay, whether you're selling some premium out there. We're going to trade some earnings next week. Don't get me wrong, we're definitely going to trade some earnings, right? Because earnings, they've kicked off, they've commenced. And we're going to talk about that in a moment. But don't get crazy, okay? Don't try to force stuff. Why? You're in a tight range, okay? Let the range actually, break. Let us come out of this, because when the range does break, okay, everything that you are and everything that you have on is going to move. As I was saying a moment ago, when we break to the upside, everything on the screen is going to move with it. We break to the downside, everything on the screen is going to move with it. We're not going to break a range, okay, without heavy degrees of correlation, which basically implies if the market actually does break to the upside, okay, the market breaks to the upside, it's going to be on a very, very strong advanced decline line. If the market breaks to the downside, it's going to be on a very horrendous advanced decline line. And that's just the world that we live in when we actually are in these ranges. And the reason you got to be careful with your allocation is, you put on like a bullish spread and all of a sudden, boom, we fall through the bottom of this range, you're going to get ripped apart. Okay. But right now, of course, everybody's thinking the same thing. Okay. It does appear that we're going to pop to the upside. I got it. Okay. If you are going to take a trade for that, though, you take it with defined risk. And the reason you want to be in defined risk, okay, some type of a spread, because we pop to the upside, you realize volatility is kind of high. So even if we do go up, volatility should crush down to some degree. Then you're going to be left like, because the vol will crush. If you just bought a call and we go higher, you might pay dearly for that. So be careful. Think about that. Buying a call might not necessarily be the place you want to be, okay, with a pop to the upside in this marketplace. Nevertheless, again, I have to tell you, though, I have not come to the conclusion that we're just going to explode to the upside. As I keep saying, with that heavy volatility, the VVIX, it's like the marketplace feels something that just, it hasn't kind of reared its ugly head. And even if we do pop to the upside, okay, I'm going to be ever on the opposing side of that trade. Maybe we see a little bit of a blow off, if you will. All right, spinning around to the next topic over here. Let's talk a bit about earnings. Earnings have commenced, and the first earnings that have actually come out, I got to be honest with you. Like, I listened to JP Morgan. It's kind of a mixed bag of goods out there. There was some good, there was some bad, right? But this thing is actually outside its expected move. It doesn't matter what you think. It's about expected move. And the expected move in JP Morgan was $7 right now, moving almost what? It was up 11, okay, up 10.50. So outside its expected move. Wells Fargo, okay, moving just north of its expected move, just over a $3 move. So two financials are out, both of them, okay, trading higher. at this point. Next week, early in the week, oh, we're going to have lots more in terms of earnings. And one of the things that we are going to do live here at TheoTRADE is, well, we're going to attack earnings. Because if the markets right now are trapped inside of some type of a range, what better time to go after earnings and earnings-based trades, like earnings-based butterflies? Okay, we'll take some bullish trades, some bearish trades. I'm also really going to consider like SPX, okay, butterflies. And like, what are you going to do in the SPX with a butterfly? Oh, you know what? Okay, it's a great time to actually take like an expected move butterfly, even inside of the SPX. Okay, come on, we haven't hit in the last 3 weeks. We're overdue. We're going to hit the upper or lower edge of the expected move. As I was saying moments ago, there's one instance in July of 2020 where we didn't hit expected move for 4 consecutive weeks. There's another instance in May of 2021 where we didn't hit expected move for 3 consecutive weeks. So although this is a bit of an anomaly, it's not like it never happens. It's just wildly unusual. The combination over here, okay, of not making a big move, but at the same time of seeing heavy volatility, okay, again, it's got me nervous. And that's why I say this marketplace, it's all about fear, and fear has this marketplace kind of locked up in a range. Nobody seems to want to step out and take any extraordinary amount of risk. And sure, the election influences it. I'm not going to deny that. Of course, there's election risk in here, okay? Beyond that, of course, there's geopolitical risk. Nevertheless, though, the marketplace, does this look like there's risk? Okay, you look at the S&Ps, you don't see anything but upside. You look at the VIX, then you see nothing but risk. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.